welcome. In this on-demand video, OJM Group Partner Andrew Taylor discusses 3 financial strategies physicians should implement as they approach retirement. If you have more questions or want to learn how to incorporate retirement planning into your financial strategy, click the link below to schedule a complimentary one-on-one consultation with one of our experienced team members.
Hello, my name is Andrew Taylor. Thanks for listening. Today I'll be highlighting 3 key steps you should take as you approach retirement. The first, develop a budget. While this might appear to be Finance 101, it is the first area where a retirement plan can go wrong. Knowing exactly what you are going to spend is a must. Once you have a feel for consistent monthly outflows, you need to leave yourself room for unanticipated expenses. Unless you have a net worth like Warren Buffett or Jeff Bezos, you truly can't consider retirement without having a budget in place. Now, we would recommend tracking a couple years of expenses. The financial institution you currently use to pay bills likely has free software available, making this task much easier than it was a decade ago. If you're like most people, tracking expenses and making a budget is far from the top of the list of ways you'd prefer to spend your free time. The good news is most banks or credit card companies are providing this information online as a value add. The information may need a small amount of auditing, but the data is easily accessible and available. If your credit card company doesn't provide the info, you can export transactions into software programs which can take most of the manual work out of tracking your spending. Now, what is likely to change during retirement? The question is relevant because today's budget may vary from your post-retirement budget. We'll start with increases. You're going to have more free time, therefore you'll need to ask yourself how you'd like to spend that time. Are you going to spend more money on vacations or on entertainment? You may also experience an increase in medical expenses as you age, so that's another consideration. What decreases are you likely to face? Well, 2 of your largest expenses while working are probably savings and tax. Now, you won't be saving any longer or not an amount of great substance, and there's a reasonable chance you'll see your tax rate decline considering you're no longer working. Now, it is imperative to have a conversation with your TPA or your CPA as you approach retirement because your sources of income will greatly influence your tax rate. Pensions and retirement plans will cover the majority of your living expenses. You may not see a decline in your taxes. Other expenses, which may also be phased out and have an impact on your budget, would be mortgage debt, debt service of medical or office buildings, and any support you may be providing for your children or your grandchildren. And once you have a budget in place, your team of advisors can get to work. So your financial advisor can work with you to assess your balance sheet and then design a customized plan to start generating income from your various assets. Your team will need to coordinate a call with your CPA to estimate your evolving tax liability. If you are currently a W-2 employee, you may not be familiar with the concept of making quarterly estimated tax payments. Once you do retire, it's very likely you'll need to start making these quarterly payments. So that'll be a change you may very well experience. And then you're also, you're going to experience quite a few changes. So your team of advisors is going to be critical in helping you understand the cash flow transition. Step 2, review your asset allocation. Now, as you approach retirement, you need to change your view of investing. Adding risk management strategies to your portfolio becomes imperative. A couple specific strategies involve adding bonds, also known as fixed income, and potentially adding alternative investments to your portfolio. So if you're an aggressive investor, this means you'll need to start limiting your exposure to equities or traditional stocks. Your focus now should no longer be on achieving the highest return, but should be geared towards obtaining consistent results and limiting downside. In a few minutes, I'll provide some data to support this thought process, and the results you'll likely find very surprising. Now, one should also be cognizant of swinging too far the other way and becoming too conservative. Upon retiring, there is a desire for conservative investors to eliminate all investment risk. Surprisingly, many retirees actually increase the likelihood of running out of money by investing too conservatively. One needs to consider the impact of inflation and how rising prices can reduce purchasing power. If you retire between the age of 60 and 65, it's more likely than not that you'll need your assets to last for a period of 20 to 25 years. Now, consider the cost of housing, medical care, or even college tuition 20 years ago versus the price of those same services today. You need your assets to keep up with inflation, and investing in stocks has historically served as one of the best solutions to combat inflation. By placing all your assets into CDs and money market funds, you run a significant risk of your assets failing to keep up with the rate of inflation, particularly once you've accounted for the cost of paying taxes. Now, the certainty of knowing that you'll achieve a positive nominal return is without question reassuring. However, it's the real rate of return, also known as the inflation-adjusted return, that should be the focus of the investors planning for retirement. Longevity risk is the formal term that should be used when referencing the concern of outliving your assets. Now, if you only take one point away from today's webinar, I can make a compelling case that this will be the one that will be the most impactful to the majority of listeners. Now, understanding sequence of return risk will help you appreciate the importance of designing an appropriate investment strategy. And I'm about to share some of the data I promised I'd be referencing. To help illustrate this point, consider two different scenarios. So the first scenario, a lump sum investment, if funds are never added or drawn from the lump sum, you can apply a data set of 25 years of random annual investment returns. Those 25 returns can be applied in any order, and your ending lump sum will be the exact same. Positive returns could be skewed towards the early years or the latter years of the portfolio. The order of returns has no impact in the end result. Now, consider the second scenario, which is illustrated in the table in front of you. So you're looking at two portfolios who are taking regular distributions of 5% of the initial value of the portfolio. Now, each portfolio continues to take distributions at the same rate, and the portfolios have an identical average return of 6.8% over the 25-year period. Now, the difference between Portfolio A and Portfolio B is that Portfolio B experienced positive returns in the early years of the distribution phase, while Portfolio A experienced positive returns in the latter years. Note Portfolio A ran out of money in year 20, while Portfolio B more than doubled in value at the conclusion of the 25-year period. Now, a closer look at the table, and you'll notice the sequence of returns are inverted. So what is this table telling us, and what preventative measures can we take to avoid experiencing the fate of Portfolio A? Now, equity market returns are random, and one can't possibly align their retirement date with the beginning of a bull market for stocks. So the table is emphasizing the need to limit downside as you approach retirement. You want to avoid waiting until the year in which you retire to become more conservative. In fact, we would advise an investor to begin to limit the range of possible outcomes to a few years prior to your to the date in which you will begin taking distributions. Now, a financial professional certainly not capable of telling you where the S&P is going to close a year from today or 2 years from today. However, an advisor can design a portfolio where a range of potential outcomes can be predicted with a high level of confidence, and that's based off stress testing and statistical analysis. A retiree with investments consisting of 95% stock, taking the 3% rate of withdrawal, actually has a much higher probability of failure when compared to an investor taking distributions at the same rate with only 60% of their assets in stocks or equities. Step 3, design a withdrawal strategy. First piece of advice we would offer on this topic is to be flexible. Now, whether you're performing surgery or coaching your children's soccer team, making a business decision, you faced an instance where you had to quickly adjust your plan. The same applies to retirement planning. Your health, market returns, a desire to relocate, or just a few examples of factors which you may not necessarily have accounted for when initially planning for retirement. Life isn't always predictable, so be flexible. Providing yourself with some cushion in the early years exponentially increases your odds of a successful financial retirement. Avoid a fixed withdrawal rate. So a fixed rate is certainly far superior to a lack of a plan. A fixed withdrawal rate could be problematic, however, if you're in the unfortunate scenario where you experience poor investment returns or a poorly performing stock market in the early years of your distributions. If the initial plan is to take 4% of $1 million every year in the first few years of during the withdrawal period, your portfolio loses money, suddenly you're withdrawing potentially as high as 5 to 6% of your assets, which may not be sustainable over an extended period of time. Now, yes, the assets are likely to recover. However, you may be dealing with a lump sum of, say, $800,000 rather than $1 million portfolio after you've accounted for the combination of both distributions and a market decline. So in this particular scenario, it would be wise to cut spending for a year or two, considering you are now working with a smaller pool of assets, which would be benefiting from a market recovery. Which accounts should I use? The makeup of your assets, current tax rates, and the level of income you will need all influence the answer to this question. And there's no simple rule of thumb answer, unfortunately. The correct response truly is that it's different for every household. Our clients have heard us talk about a 3-bucket approach to planning for retirement. When this term is referenced, we're referring to taxes. Now, tax planning in retirement could be a full video in and of itself. You should understand that there are 3 basic tax treatments for investment accounts. So Roth IRAs and potentially cash value life insurance can be returned to investors on a tax-free basis. Distribution from qualified accounts and traditional IRAs, short-term capital gains, and most form of interest are all taxed at ordinary income rates. Long-term capital gains and qualified dividends receive a more favorable form of tax treatment under current law when compared to ordinary income rates. Historically, these rates have evolved, which can make tax planning very challenging. So our advice is to fund all 3 account types while you're in the accumulation phase. A diverse mix of account types allows you to make the tax laws work for you rather than against you. Remember, the U.S. tax system is tiered with marginal tax rates, which means every dollar of income you receive is not taxed at the exact same rate. If you find yourself in the 37% federal tax bracket, which is the top rate as of today, doesn't mean that every dollar you earn is taxed at 37%. Your effective rate may actually be much lower. And then the utilization of specific investment products. Now, the prudent approach here is also very dependent on investor circumstances. The need for tax efficiency and one's withdrawal rate influence the type of products which ultimately are appropriate for you. If limiting tax on distribution adds value to your situation, tax-free interest from municipal bonds and qualified dividends from stocks or ETFs may be suitable. If you aren't facing a high tax bracket in retirement, investment products with distributions taxed as interest, meaning taxed at ordinary income rate, could be more attractive. Debt instruments, which are taxed as interest, have historically offered a higher income stream, which appear to be superior, at least on the surface, when compared with other forms of income-producing assets. However, prior to utilizing these ultra-high yielding vehicles, you should be aware of some of the pitfalls of chasing yield. A product offering interest rates well above market average typically has significant risk. And how do these products achieve these returns? They either have higher payout rates by lending money to companies with very questionable cash flow, or the investment itself is using a form of leverage, which means that they're borrowing money and investing the difference and utilizing that technique to enhance yield to pay out to the end investor. If you have specific accounts which you may view as legacy assets, you may want to allocate your growth assets into their growth investments into those vehicles. That may be a reasonable strategy for those specific accounts. Hopefully you found a few actionable items to implement from today's recording. There's no one-size-fits-all solution for retirement planning. Spending rate, marginal tax rate, and account registration of your assets are all factors that influence the strategy which may be most appropriate for you. The ideal plan is truly customized and tailored to the needs of you and your family. Thanks for tuning in.
OJM is a multidisciplinary wealth management firm. For nearly 2 decades, our firm has helped physicians across the U.S. reduce taxes, protect assets, and achieve their financial goals. OJM Group offers viewers a complimentary consultation where we can answer your questions to see if our firm might be a good fit for your situation. Simply click the button below to schedule your free consultation. We hope to speak with you soon. Thanks for watching.